Hi everyone, it's Grace. Welcome back to my channel. In last week's video, I provided you with a very important topic, which is how to use the upcoming recession to get rich. And I do think that there are a lot of opportunities to capture. And please check out here for that video. All right, so for today's video, I'm going to talk about a very interesting topic, which is that I believe the Great Resignation is over, and then 2023, especially for the labor market, is going to be a return to the office trend. All right, so before we begin today's video, remember to subscribe to my channel and click on the bell button so you get notified immediately when new videos like this are uploaded. Also, feel free to give this video a thumbs up if you find it useful. Also, please consider contribute to my channel, whether through PayPal, Cash App, Zelle, or QuickPay. And I'll provide the links and a link tree in the description down below. Thank you so much for your support. All right, so two of the most popular buzzword during the pandemic boom is the Great Resignation and remote work. So what I find very interesting is that this period lasted about 2 years and 6 months, from March 2020 to October 2022. And I remember very, very clearly that when the pandemic first hit the US market, the whole economy was plunged into a recession type of situation. And during that time, the Fed really decreased the Fed funds rate from 2.5% all the way down to 0.08%, so near zero. As you can imagine, there was a lot of free money, easy money pumped into the market, like basically ballooning all kinds of assets, including real estate, right? But as we see this year, a lot of things happened and changed at the same time. So in October 2022, was the third consecutive 75 basis point imposed by the Fed. So as you can see, immediately after the decision, there was tech layoffs, right? Especially in a tech world, companies were immediately taking actions to lay off a proportion of its workforce. And I do believe that this really reflects the shift in the labor market. So during the pandemic boom, which was at a peak of 2021, the labor market supply was right here. And then the job opening was right there. So as you can see, there was a large gap between them. And at its peak point, 2 job openings is only for 1 applicant. So the labor market shortage was really a painful situation, especially for companies who were trying to hire more people to satisfy the demand. All right, so right now we're seeing that it's shifting. So the supply is increasingly becoming higher, and then the demand is coming down. And I do believe that that type of labor market trend is intended by the Fed. So it really doesn't need to go above too far, because obviously when unemployment rate is too high, it's not good for the economy. But the unemployment rate needs to increase to a level where it's just enough to bring down the inflation, the core PCE, to 2%. And I do believe that it's a very, very hard task for the Fed. All right. So what we're seeing now is that companies gradually move their work schedule from a hybrid schedule to return to the office. So for the hybrid schedule, it's usually a 3 days in office and then 2 days remote work type of situation on a weekly basis. But to me, that doesn't really sound that different from a commuter basis, because if you have to go to the office and then return to your home to work on a weekly basis, you can't really travel that far. So I do think that we're quickly going into the return to office work mode, and then into 2023, it's going to be completely back to the pre-pandemic level, which is the return to the office work trend. All right, so the next part, we're going to answer a very, very important question. So we're going to see what does the return to office work trend does to the commercial real estate market and also residential real estate market. There's a lot of things that's going to happen in these two markets. All right, so for the commercial real estate, one of the most important type of real estate is the office building. A lot of companies actually own these office buildings, and they have been, the vacancy rate for these office buildings were quite high. A lot of companies were, able to, were kind of encouraged to provide their employees to work remotely. So there were not many people who were willing to work in these offices, but right now people are back to the office. So the vacancy rate for these office buildings is going to drop, and then the vacancy rate for these co-working space is going to increase. So that will have a lot of impact on the co-working companies. So just to show you a little bit of what that means, I actually provided the chart that was just came out this Friday. So Fitch Rating actually just downgraded the WeWork bonds from triple C plus to triple C. So this type of downgrade really reflected one of the most important things that you have to remember when it comes to real estate. That is, people are no longer able to remote work because they have to return to the urban centers, to the office buildings. Because of that policy, or because of that labor market trend to return to the office, the cash flow is no longer able to be monetized, either by WeWork or any other brands. Because currently I'm located in Miami, where there's a lot of people who would prefer to do remote work. There are also other brands such as Industrious, Expensive, or any other type of properties that provided this type of remote work trend, right? So I do think that is a correct reflection of this trend. And then another company that I want to share with you is Airbnb. It's according to, in my opinion, Airbnb is a very successful company. So when COVID immediately hit the US back at the beginning of 2020, Airbnb did several things that successfully shifted during this very unpredictable time. So the first thing that it did is to shift the algorithm to reflect more local listings to people who live in local areas, because there was a need for people to quarantine either in hotels or any kind of hospitality listings. And then another part is that they're also encouraged to work from home, right? So people are able to, like back then, people were shifted from the work in the office to work to remote work, right? So the second thing that it did successfully was that it actually was able to help the employees that were laid off to transition successfully during this period, to make sure that they find job replacement successfully, and that they have minimum disruptions in their employment. And the third thing that it did was to provide disaster fund for the hosts who have the local listings, who are property owners, to make successful shifts as well. And I do believe that in this return to the office trend, Airbnb is also able to shift successfully during this volatile time as well. Right, so those are the two companies that I want to share with you in terms of the commercial real estate. All right, so what does it mean for residential market? How does return to the office going to influence the residential real estate market? It's going to be a mixed situation. So I actually made a video before which shows the most common trends during the pandemic boom. And I'm going to provide a link to that video so you can check it out here. Right. So remember, right now, people are returning from the suburban areas to the urban centers. So some of these urban centers are very separate from their suburban areas. They're either from across the country from west to east, or they're north to south, right? So out of state. And some of them are actually pretty close to each other. So for those situations where they're close to each other, I don't think it's going to have a lot of impact. But If the urban center and the suburban areas are far away from each other, then you obviously have to pay a lot of attention. And there is the rental situation, and there's also the sales. So when you're looking at the rental market, the inventory is going to increase, and the vacancy rate is also going to increase because people are urged to return to the office, so they're no longer able to work remotely anymore, right? So that does have an immediate impact on the rental inventory and also price. The rental inventory in these centers is going to increase really, really quickly, and the price is going to come down as well. So you're going to see an immediate impact on those markets. All right. And then when you're looking at the sales inventory, obviously it gets a little bit more complicated. You have to see whether it's a primary residence or is it a rental market. So for people whose companies are located in another state and their primary residents are located in like far away from their companies, they are probably going to be caught in a situation where I'm going to either keep my job or keep my property. It's like either this or that. So that eventually means that there are more sales inventory hitting the market as well. They're either forced to sell it or convert it into a rental property. But either way, the rental price is going to hold up there for too long. It's going to come down because of this return to the office trend, right? And that also means that the price is going to correct as well. But for the residential market, it really depends on the local situation. So that's why I update on a monthly basis for the housing inventory and also pricing for each metro areas. So for today's video, two of the most important takeaways. The first one is that you have to look at the short-term trend, especially for the migration patterns, which I typically would range from 6 months to 2 years. So if you're looking at 2 years, it sounds like longer than a year, but for real estate investment or economic activity, it's really not that long. Especially when you're seeing this trend happening pre-pandemic, during pandemic, and after the pandemic boom, right? And then there's also a long-term trend for the migration pattern, which is really determined by the Fed's policy, by the economic cycle, and also the geopolitical trends that's taking place not just in the US but also on a global scale, right? So if you have any questions relating to these factors and how they're going to impact on your investment decisions, whatever it may be, feel free to send me an email so we can talk more. All right. So I hope you enjoyed today's video. So for next week's video, I'm going to update on the November housing situation for each metro area. All right. Thank you so much for watching today's video, and I'll see you on the next one.